Welcome everyone to this presentation on Australian equities portfolio discussion. For those of you that don't know me, I'm Simon Marra, I'm the Managing Director of Prime. And today we've got a really interesting discussion about some of the changes that we have been making to the way that we are going to be managing Australian equities. We also have our new investment committee member presenting to us today, Marcus Bogdan. We also have our key team members, Cameron Morcher and Mark Johnson, who both sit on the investment committee participating in today's discussion as well. So welcome to everyone. Thank you for joining us. It's very much appreciated. Of course, we need to cover our general advice disclaimer. The information is there, but this is not personal advice. We'll be covering some general concepts and you should speak to your advisor as to how some of the concepts we talk about apply to your portfolio. Okay, so we might kick off with the presentation, and today is very much about introducing our new team member and talking through how it is that we're going to be approaching the Australian equities management piece, talk about a bit of the why, also consider where we think we are in the cycle at the moment and how our slant is changing slightly. But what we'll start with first is an introduction to Marcus. So for the clients that haven't as yet had a chance to read our communication that went out around about a week ago, I might just cover some of that background information for you. So Marcus has joined the investment committee effective around about a week ago. He is an Australian equities specialist. In fact, he's got 25 years experience and an enviable track record, some of which we will talk about shortly. He's also the Chief Investment Officer of Blackmore Capital, and you'll see Blackmore referred to throughout this presentation as well. And we will be leveraging off the resources that Marcus has access to. And there are 6 team members within Blackmore. Some of the reasons why we have chosen to work with Marcus, and Cam and Mark will cover off some of that decision-making process later on in the presentation, is very much about the cultural alignment and a similarity in terms of philosophy as to how to manage Australian equities. So importantly, Marcus will be working with the existing investment committee, very much a focus on the ASX 200. But the real point of difference with Marcus is his strength and his discipline around the structure with which he assesses companies. And to give you a bit of a feel for that, in fact, Marcus has done already this financial year, including what's been a very different environment, already done 150 company visits. So the detail with which he assesses companies is very important. And we think that puts us in a good position to make the right decisions for you. As I said, strong cultural alignment and a very good track record, particularly over the last 6 years. Just a little bit more detail, and Marcus might start blushing in a moment given how much I cover off on him here, but it is important to understand Marcus's background and where he's come from. So as I said, 25 years in equity investment management. All the big brand names are featured on this slide in terms of where Marcus has worked. He started out as a graduate research analyst at Macintosh and Merrill Lynch, for those of you that remember back to 1992 and that sort of era. Also a research analyst covering chemical, logistics, transport and industrial sectors as well for 8 years. He's been at Credit Suisse, at Citigroup, and also importantly at Cooper Investors, which I think has formed a lot of the thought process as to how Marcus thinks about managing equities. As I said, he's also been Chief Investment Officer at Canaccord Genuity as well, and has also managed 2 Australian equity funds there, developed those from inception. So today, Marcus is an investment committee member of Prime, but is also the Chief Investment Officer of Blackmore Capital. So I'd like to give Marcus a very warm welcome to the Prime team and give him the opportunity to talk a little bit about how he's starting to influence our approach to managing Australian equities. So welcome, Marcus, and I'll hand off to you at this point in time.
Thank you very much, Simon. Absolutely delighted to enjoy the Prime Investment Committee. To start off with, let's look at the portfolio. We have a very clear investment objective, which we hold ourselves accountable to. We're measured both internally and externally. And our investment objective is clear. We want to deliver long-term capital growth and income growth for our investors with our exposure to ASX 200 companies. And we want to do that with lower volatility and lower and better downside protection. And we do that, we measure that on a monthly basis, and we've also had a range of different groups measure us externally. Zenith, who we've got a rating with, has looked at our fund, our track record for almost seven years. And for each key period where our performance has been in the top quartile, and our performance since inception, where we're compared with 109 other fund managers, we've ranked 6th in that period of time. And that's important on the performance side, but equally important is on the risk side. And our volatility and our standard deviation has been noticeably lower to the benchmark and to other industry participants. Our downside protection has been better than both the market and other industry participants as well. And we look at risk-adjusted returns for our investors, which looks at the duality of both return and risk. If we turn to the next slide, the way that we have achieved that is really through a very deep sort of analytical framework in the way that we look at the companies in the industries that we invest in. Our universe is the ASX 200, and we use a range of different lenses for every company that we put into the portfolio, or every company that we consider. The first part of that is that we do a deep dive on the earnings quality of the companies that we invest in. We pay a lot of attention to historical returns, understanding where companies are in their investment cycle, understanding the breakdown of their earnings, how much is through organic growth, how much is it through acquisition, understanding the cash flow generation of the companies that we look at. And we really want to understand the sustainability of returns. And we also do a deep dive on looking at the accounting transparency of the companies that we're investing in. From a company perspective, we look at from an industry perspective. We want to look at the size of the industry, the growth rates, the number of participants, the barriers to entry, and also, and increasingly so, the regulatory overlay that sits across industries. We do a lot of work at an industry level, understanding the returns of industries through long-term trends, and we do that through visiting a range of competitors and industry participants. The third element, which I think is probably the most important of my career, nearly spanning 30 years, and for each of the decades that I've worked in, there has always been a significant crisis. When I started was at the last Australian recession in 1991, where we went through the worst Australian banking crisis in 100 years. The global financial crisis in 2007, and now what we're seeing with the corona pandemic that we're experiencing at the moment. In all of those situations, balance sheet strength has been imperative. Liquidity and solvency are incredibly important, and it's something that we focus on for our entire investment process. So we are more attractive to companies that have got good coverage ratios, good gearing ratios, because we want to be able for companies to be able to work through periods where there are potentially significant reductions in economic activity, and we want companies to be able to also have the options and the ability to invest counter-cyclically. If we look at the fourth lens that we look at, we spend a great deal of time with management, with boards, and with competitors. We want to see what management say and what they actually execute. And we do that in an iterative process. We are constantly going back to companies and industry participants. As Simon alluded to, so far this year, we've engaged with 150 meetings this financial year, over 300 last financial year. And that's the sort of the cadence that we have in terms of our primary research that we do with the companies that we invest in. The next element is that for all of the companies that we do quite significant ESG overlays because ESG can have an impact on long-term valuations, long-term opportunities, and long-term threats. And so that is an important assessment that we do. We spend our sixth lens that we look at is that we do deep valuation work on the companies that we invest in. We use a range of different methods to cross-check our valuations. And one of the core aspects of what we're trying to do is we're trying to buy quality at a reasonable price. And so that valuation process is important. We bring all of those elements together to put them into a portfolio, and we want our investment portfolios to have certain attributes. And those attributes look at things like the attributes of resilience, of lower volatility, of lower investment drawdown, and a faster recovery from drawdown back to peak performance. So that's our investment methodology. The next element that I would like to discuss is the actual portfolio, and this is where investors are positioned. And as you can see, those names that represented there are core Australian brands: BHP, Woolworths, Commonwealth Bank, Wesfarmers, Cleanaway, CSL are core holdings in the company, and then we have a range of other companies that we believe that exhibit good prospects for our investment. So that's the current portfolio that we're currently invested in. The next slide, really, I would like to start to talk about our perspective of where we are in the investment cycle. This year has been remarkable. We've gone through a 100-year pandemic event where markets peaked on the February the 20th. We then saw a 36% decline in the ASX 200, and we've seen a recovery from that point in time. And so from our peak, we're still down around 14% from our highs. If we turn to the next slide, the pandemic has had a significant impact on both earnings and dividends for the Australian market. And earnings in the last reporting season were down around 20%, and dividends were down around 25%. But importantly, we do firmly believe that the reporting season that we've just gone through has been the trough in earnings for the Australian market, but trough in both earnings and dividends. And so we are now at the next stage of the recovery. If we go to the next slide, is that we're seeing a trough in EPS, and we're also seeing a trough in dividend yields. And now we're at an important inflection point in the Australian market where we do think we're on a long road of expansion, of seeing both earnings and dividends recover over a period of time. We do think it's going to be a 2 to 3 year turnaround for the Australian market to come back to where those earnings peaked in September 2019, but we are at the nascent stages of that. The recent first quarter reporting that we've seen and the AGM updates that have come through in the last week or so have been encouraging. And we have seen a broad revision, a positive revision now in earnings, which is the first time we've seen that in over a year and a half. And so that pathway to recovery has begun. It will be long. It will be gradual, but importantly, it has already started. If we turn to the next slide, this provides you really an understanding of the companies that we own. And the portfolio at the moment, there is a barbell approach. We do want to be well positioned in companies that have been able to deliver earnings and dividends in the pandemic. BHP, Brambles, Cleanaway, Woolworths, Wesfarmers, CSL have been able to demonstrate resilient earnings and resilient dividends. They are global leaders in what they do. So that's the evidence there of earnings and dividends. But we've also got an eye on the recovery. We are confident around a vaccine that will be widely distributed in 2021. And we're already seeing the Australian economy start to recover. And from a broad macro perspective, I think Australia is in a very enviable position in terms of where we are in the pandemic compared to what we're seeing in the United States and Europe. And so we do want to be exposed to those companies that we feel will be well positioned to recover from an Australian uplift in economic activity. And some of the names that were invested there are in Ampol, in News Corporation, in Australia's largest port operator, Cube, Ramsay Healthcare with elective surgery now starting to come back. And then we've also begun reinvesting back into the Australian banking sector. If we turn to the next slide there, we were effectively not invested in the Australian major retail banks from 2015 to 2019. We did feel that they were over-earning in that period of time, and particularly when we were comparing them with global banks. We could see that they were broadly issuing capital as they were building up their capital positions through the requirements of Basel. And we could also see that there was a range of compliance issues there which were putting great pressure on the cost structures of those banks at a time when earnings were starting to slow. But that underperformance has been significant. Australian banks have underperformed the broader market by around 37%. We feel that through the Hayne Royal Commission, the write-downs that we are seeing now, that is now starting to be reflective in bank valuations. You've seen substantial reductions in return on equity, substantial reductions in their net interest margins, and we believe that now that they are at the trough stage and that with a better economic backdrop, that we will start to see a growth in credit. We've started to see the first easing of regulations there with responsible lending. And we've also importantly seen a rebasement of the dividends. And we feel that rebasement of dividends is in a far more sustainable position for banks now to gradually grow their earnings and to grow their dividends over time. And we think that once we get through this reporting season coming up with the Australian banks, that rebasement will provide, sustainable dividend yields of around 4.5%. Fully franked. And if we just turn to my final slide, this just gives you a sense of the sectors that we're invested in. It is important that we run a portfolio that is diversified. It has different sources of return, different sources of risk, and where we have our tilts and our weightings in the portfolio. Historically, we have been overweight healthcare. Australia has world-class healthcare companies. CSL, ResMed, Ramsay, Sonic are all significant global players in healthcare. We like the argument around an aging demographic. We like the resilience of their underlying business and their strength of their balance sheet. And we do think that those businesses can grow at a greater rate than the underlying economy. We do have an overweight in good defensive industrial companies such as Brambles and Cleanaway, which are really supply into essential industries or consumer staples. We have an overweight in consumer staples. I think the evidence of the performance that we're seeing in Coles and Woolworths and Wesfarmers is particularly encouraging, and also seeing their models adapt through the pandemic and really do some significant reinvestment in their online offering. And Coles this morning has reported a 57% uplift in their online offering. We are rebuilding our position in financials. We've liked Macquarie Bank for some time, and then we're rebuilding our positions back in the retail banks as well. So the portfolio overall is well diversified with good industry leaders with strong balance sheets. I might pause here now and hand over both to Mark and Cameron to talk a little bit more about the investment committee.
Thanks, Marcus. That's a pretty thorough coverage of the portfolio and where your thoughts are at the moment in terms of market and sectors. So just wanted to share a little bit about the journey to bring you and the team on board. I mean, certainly inviting somebody onto the Prime Investment Committee is not something that we've sort of done lightly. We undertook a pretty extensive process to find the right fit for the Prime Investment Committee, but also the right fit for our clients. So the process involved a reasonably intense couple of months of discovery and due diligence on a range of fund managers across the country. And oddly enough, in lockdown, the video conferencing probably made the process a little bit more efficient, just in terms of time-wise and not spending time travelling. So that was helpful. But over that 2 months, we conducted more than 25 meetings with a range of fund managers and consultants. And through the process and through a couple of different conversations with Marcus and the team, it became evident that they were really the best fit for Prime, and we think for our clients. And we're also thankful that Marcus and the team were similarly minded and be happy to be part of the Prime Investment Committee. Some of the things that we were looking for and bringing on someone to the investment committee have probably been covered off a little bit through Marcus's presentation. But just to highlight a few of the key objectives, we wanted to work with a group who could contribute to the Prime Investment Committee and present well-researched and independent ideas. We wanted a group that had a history of performance through different market conditions, and also not overly biased towards a growth or value style of investing, because we're investing for the medium to long term. And yeah, quite the fact that the guys do a lot of research, company visits, was an absolute is a positive. And also the fact that they've got a well-diversified portfolio, so we're avoiding concentration risk and that type of thing. So we've always had a focus on blue chip companies as core holdings across portfolios, and Marcus and the team clearly have got a shared philosophy in this regard. So looking forward to progressing our portfolios and implementing some of these changes. I'll hand over to Cameron Morcher, who will talk about our two distinct different investment solutions. Over to you, Cam.
Yeah, thanks, Mike. So there's two key ways that we can access Marcus's investment thinking and ideas. The first is really where clients can adopt a discretionary approach. And by that, I mean where clients are comfortable handing over the underlying investment decision-making to the Prime Investment Committee, of which Marcus is a key part. Those discretionary portfolios lead to Prime's Australian Equities SMA. So it's an acronym that stands for Separately Managed Accounts, but that is our preferred Australian equity portfolio of holdings. Being a discretionary portfolio where there are changes made to the underlying investments, they will then automatically flow through those accounts into clients' portfolios. And we'd anticipate the Prime Australian Equities SMA to very much be closely aligned to Marcus's preferred holdings by November the 1st. So when Marcus and the investment committee do change the weightings to particular holdings, given opportunities out there in the marketplace, these will go through in a timely and efficient fashion into the portfolios. Those portfolios are all operated on the Macquarie administration platform. The second option for clients out there where they want to maintain the investment decision-making control themselves, we term these clients client-directed portfolios. These portfolios will require tailoring, so we'll use all of Marcus's and the investment committee's ideas, and we'll tailor those ideas and come out to clients with recommendations as to what the advisor thinks is appropriate for the clients. We'll have a robust discussion with the clients, and the clients will then ultimately have the final investment say-so over what does go into their portfolios or not. So there's a couple of different options out there for clients. There's certainly different ways to do this, and there's different fees and charges involved. I'd encourage all of the clients to have a chat to their advisors to explore either option if they want to learn more about that. At this point, I might hand over to Simon.
Thanks, Cam, and also thanks, Mark. And Marcus, I think you were very humble. You just towards the end of your presentation, you scooted over one page, which I think is worthwhile highlighting because it was a key consideration in our decision making, which was the track record that you've got. So just, if possible, would we be able to flick back just to that portfolio performance, historical returns, and I think there might have even been another slide there as well. That I think this is a good representation of part of the appeal of Marcus joining the team. But Marcus, do you want to just cover off on that and just sort of round that out for us, and then maybe I'll jump onto the communications piece thereafter.
Yeah, sure. And so since I started these portfolios almost seven years ago, we have been able to compound our growth at 9.5%, which is well above the market, the index that we're measured against, which is the ASX 200 accumulation index. And I think we've been able to consistently perform well through a range of different economic cycles, both in terms of performance and volatility. We are a low turnover portfolio, and we really want to be able to pick companies that we believe that will be able to compound their earnings and growth over time.
Yeah. And look, thanks for highlighting that, Marcus. And I think obviously we have to make the natural statement that past performance isn't necessarily an indication of future performance, but it is encouraging for us to see over that extended time frame that and those different conditions that solid results have been achieved. If possible, we might just go to the communication slide here. And look, we're at pains to point this part out of what we endeavour to do with our clients, with you, and communication is a really key thing. So hopefully you see that you get regular communication from your advisor, and Cam touched on that in a bit of detail in terms of how we seek to tailor everything that we do based on the client's preferences. We have our weekly market update, which obviously goes out weekly, but we also have specific recommendations and explanations as to why we're doing particular things. This services through regular reports, but there will also be increased ad hoc communication. and feature pieces. An example of that might be ESG is something that is increasingly talked about from an investment point of view. Marcus, Miles, and the rest of the Blackmore team have some great experience in that area, and they bring that to our team and our investment committee. We might very well do a session in particular on that and how we're approaching investment from that perspective. Obviously, with things like reporting seasons and the ones that we've just gone through, that's an important opportunity to reflect on the portfolio and any changes that might be made, and very interesting that Marcus has made reference to that as well. I guess in short, we've obviously had to adapt to a different style, during this COVID period, and webinars and videos have featured more prominently in terms of what we do. We want to continue to be able to do that. I think the key thing is just to probably highlight that being proactive, being present, and consistently seeking to increase the expertise and the experience of the Prime team to try to get the best result for clients is a core part of our mantra. So hopefully you feel like we are being present, and we've also been very keen to make sure that we have communicated this change to our investment committee, as we were very open and transparent in terms of the transition of Jonathan Bayes. So important to understand the investment committee has access to lots of different resources. We also have other external consultants that we draw on, groups like Zenith and Morningstar, which assist us in making better decisions that are appropriate for you. And look, I would highlight here also, a bit remiss of me not to highlight at the start of the presentation that should you have any questions, you could have logged them or can log them through the Q&A tab within this Zoom session. So I'm going to give it a couple of seconds to see if anyone would like to ask some questions through that format. But I might actually just kick off with one question for you, Marcus, without sort of putting you on the spot. I'll put you on the spot. Mm-hmm. Just the last few days, a little bit more volatility in the market, and US election coming up, and I just it's interesting to see how things are starting to move. And just, do you have a view on that volatility piece? Do you have a view on US election potential impact and things like that? And I guess I sort of caveat this question on the very clear view that you've brought to the committee, as the committee's already had, that it is really about the overall portfolio of Australian equities and how to get that right, and if you get that set right and the dynamics that play off between those particular holdings, that positions you best for the long term. So I'm kind of asking you a short-term question, knowing full well that the approach is about sort of mid to long-term investing. But can I throw that out there and just see if you've got a particular view at the moment?
Yeah, sure. I think that's unsurprising that we will go through periods of heightened volatility. There are a number of global challenges that we're facing all of the time, and obviously the increased level of the pandemic in the Northern Hemisphere is definitely a weight, but it also points to the fact that that focus that we have on the domestic economy as well, and so that's where we're seeing the recovery, and we're actually seeing that in the numbers that we're talking to these companies. These companies are updating us at their full-year result, at their AGM and their first quarter. Those numbers are encouraging for some of the companies that we have in the group. One of those companies was Healius, which is the second largest pathology and diagnostic group in Australia. They had an uplift of revenue of 18% on revenue, 151% on earnings, and those sorts of numbers are particularly encouraging. And where we are in those Northern Hemisphere markets, we are with global leaders with resilient businesses. CSL has over 50% of their revenue generated in the United States, and yes, they've had an impact in terms of the collection of plasma, but that is starting to recover. But they've also had an incredibly strong uplift in their vaccine business, in their flu vaccine business, where the demand for that has been absolutely at record levels. The other exposure that we have in the Northern Hemisphere is through Brambles, but Brambles, 80% of their business is supplying CHEP pallets through the consumer staples market. So we are navigating through this. I think it's important to be well diversified, to be with market leaders and with companies that we think will actually improve their market position as we come through the pandemic. I think, you know, companies like Woolworths, Wesfarmers and Coles are actually strengthening their franchise through this crisis by really putting a lot of resources into online, capturing those sales, but they will be really important barriers to entry for other participants. And so that's how, you know, that's, I guess, how we're thinking about it at the moment. We want to have, and as I said before, we've got companies that have got earnings resilience, and then we've got companies that we can see that will benefit from a recovery, and we see that recovery particularly playing out in Australia and in Asia first, before we see any recovery in those Northern Hemisphere markets.
Fantastic, thank you. A great explanation. Kindly, Simon Kennedy has popped a query here just in our chat, and there's a couple of other questions in Q&A. I'll just cover Simon Kennedy's question first, and this is an open question in terms of the committee participants. But what's your view on property and infrastructure as a class? For example, Centre Group, oversold or more pain to come? Who would like to take the courageous role of answering that particular question?
Yeah, I might just talk about the listed space and what's in the ASX 200, because there is, significant REIT exposure to retail and commercial property. I think that those write-downs will be still challenging for those types of groups. Our exposure in property in the ASX 200 is where the growth is happening. We're invested in Goodman Group, which is the largest provider of online distribution centres. We think that thematic has obviously increased dramatically through the pandemic, but we do think that is a long-term theme. So that's where our preference is. We're also invested in retail petrol stations through Waypoint. And one of the reasons we like that business is that the underlying tenant is Coles Express. The weighted average lease expiry is over 11 years, and it has a 3% escalator there in rents over that 11 years. And so strong tenant, long lease, with escalators there that we can increase both the earnings and the distributions over the next decade. We have not circled back to retail property trusts at this point in time. Our conversations with retailers has led us to see that there will be closures of retail footprints, and that will be ongoing as they successfully move to online. And Premier Investments is a classic case where they will be aggressively renegotiating their contract terms with the landlords and also reducing their footprint. So, we've got a very specific tilt into that where we can see that there is still earnings and dividend growth. But there's a wider question here around property and infrastructure, which I might leave to other members of the investment committee.
Well, look, I am conscious that, great answer, and I think that gives us some great context, but there are a few other questions here which I'd love to get to if that's all right. So we might just turn the tilt to that at the moment. But Michael McLean's asked a question, with the easing of COVID-19 restrictions, Marcus, do you have a view on travel businesses like Flight Centre and Qantas?
Yeah, I mean, I still think that it's interesting with Qantas. I mean, that domestic franchise is incredibly important, and to get that Melbourne to Sydney route, which is one of the busiest routes in the world, operating. I mean, Qantas has done all of. It's an incredibly disciplined organisation. It still has sufficient liquidity in its balance sheet. But I do note, what the authorities have said around international travel, and particularly the Northern Hemisphere. And I look at that on a daily basis because I do spend a lot of time in those markets looking at the companies that we're invested in. And I don't think that uplift will occur until at least this time next year. So yes, we're looking at it, we're mindful of it. I think we want to sort of bring back to things that we can see are in the recovery phase today and in this next quarter.
Yeah. And just to follow on, Marcus, you are the man of the hour, so you're getting a few questions here, which is great. Sure. But John McKinley has kindly asked a question about Blackmore not investing in, or having a perception that Blackmore doesn't invest in mining. I think that's a misconception. Do you want to just clarify that?
Yeah, absolutely. I mean, we will invest in any company in the ASX 200 if it goes through the various filters that we use: earnings quality, industry position, balance sheet, management, execution, valuation. We do not negative screen on companies, but we do overlay an ESG overlay around industries, around materiality and the impact that does have. We recently did sell our position in Rio, but we hold a significant position in BHP. And we did sell Rio on the premise of what happened in the Pilbara and the destruction there of those rock shelters, the indigenous rock shelters, which were 46,000 years old. And the reason we did that was because we felt that through a close inspection of the parliamentary committee dialogue that they had with that there was a level of internal dysfunction in Rio around that decision making. It was lawful that they were able to destroy those rock shelters, but they were not keeping up to date with the indigenous group there. And because there is difficult to have any restitution there, you cannot return them back to where they were. We do feel, and we're seeing that also in the environmental laws and the potential of environmental laws changing in WA, that this will be material in the regulatory overlay that will occur through greenfield, brownfield developments for those groups. It will increase the cost of capital. It will increase the cost of doing business there. And so hence that's the reason why we sold Rio, but we still hold BHP. And we do want to have those assets in the public sphere, because in the public sphere, they have much greater transparency.
Perfect. Great answer. Thank you for that. And there is, I think this is our final question, and a really good one. Can we, being Prime, increase our transparency from the investment committee with reference to SMA decisions and portfolios and performance? I'm really hoping that today's presentation is a bit of an indicator as to the level of transparency that we want to have and that we want to report on. And I guess we've been at pains to start to show clients in a timely manner how we're making these changes. And really from 1st of November, you'll actually see how the SMA has been repositioned to be more reflective of a combination of the Blackmore and the Prime Investment Committee positioning. So that has all started to occur over the course of the last week, and we'll report to you very shortly thereafter from 1st of November. We wanted to have a very clean and I guess pure example of what we think are our best ideas within the SMA, as we have repositioned the team and we have taken a different view. So hopefully you'll see better communication from us on that front there. And again, you know, the other point that was made, and I think well made by Cameron, is that you know, we do respect the fact that not every client will want to have their portfolio discretionally managed through a separately managed account. So there'll be a lot of transparency for our direct clients as we go about respectfully you know, applying these best ideas to individual portfolios. And so hopefully you see a high degree of transparency there. It really is a key part of where we seek to work closely with our clients. And please call it out if you feel that we could be better on any of these things. Absolutely happy to try to address that in the best possible way. I am conscious that I think we've had plenty of good questions, which we really do appreciate. And by all means, you know, if there are things that come to mind after today's presentation where you'd like to get them answered, you can filter those questions through to your advisor, or alternatively send it through to the group email, and we'll absolutely come back to you in a very timely manner. Yeah, I will round out here, and then I might throw to Cam and Mark for just a couple of final comments. But on behalf of myself, I'm really pleased to have Marcus, Miles, and the other 5 or so team members from Blackmore participating actively on the Prime Investment Committee. We believe that this is the right decision for the right reasons, and you know, our goal, our endless goal, is to keep on trying to be better for our clients and get them the best possible performance. Please ask whatever questions you desire. Thanks to Cam and Mark, who led the process of appointing Marcus to the committee. We think it was a really important decision, and most importantly, a very diligent process that we went through. And I think that goes to how we try to think about things here at Prime. So thank you to all of you, gents. I might quickly throw to Cam and just see if there's anything you want to highlight before we finish up, and then maybe over to you, Mark, and we'll wrap it all up.
Yeah, I just wanted to leave the audience with the impression that we have always spoken about preserving capital first and foremost at Prime for our clients, and I think the philosophy of Marcus and his team is really focused on that, sort of focusing on lower risk in their portfolios, focusing on lower portfolio drawdowns, and certainly outperforming the index moving forward. So I think it's a great chance to reset portfolios with that in mind, with a really strong, well-resourced team.
Yeah, and I guess, you know, talking to Marcus and the team's been one thing, but as part of the investment committee, we're also talking to a range of fund managers. And I guess one of the themes that has been coming through in more recent times is just the response, I guess, from a fiscal point of view, from a government point of view, to the pandemic has been pretty strong. And likewise, monetary policy has you know, been central banks have been active to assist markets and to make sure that the conditions for businesses to get out and start to grow their business and so keep some of those costs down in terms of interest. So I think there's a growing belief and confidence that, as Marcus sort of pointed to earlier in the presentation, that getting a little bit more optimistic about where markets are positioned, where valuations are at, and where some of this income is going to come from, because clearly, you know, the banks having cut dividends pretty severely as one sector, but other businesses have as well, has had an impact on people's ability to draw pensions and that kind of thing from income out of their portfolios. But if we are at that low point and things are getting a bit more optimistic, it's just something to note, and I think that helps with how we position portfolios going forward, just keeping those key fiscal and monetary stimuluses that have been put into the system. So that's a positive thing.
Yeah, well said, Mark. And I think it's an interesting view. You know, we were probably pretty pessimistic 6 to 12 months ago, and even beyond that. You know, that sort of cautious optimism is probably something that you'll hear quite a bit from us in terms of how we're positioning things. So maybe that's a great way to round it out, cautious optimism on a positive note. And to again, thank everyone for their participation and for their attendance. And we hopefully speak to you very shortly. Thanks for everyone.